Yes, so good evening, everyone. Good morning if you're dialing from somewhere that's out of Africa. So today we are having our second webinar, and the webinar is on money investing skills. Last week we had the money saving skills, and Elizabeth took us through what we could do with regards to how to save money. And I think one of the things that she mentioned was around creating a budget and being disciplined with that budget. So karibuni sana for our second session. Elizabeth has joined us, and karibu sana, Elizabeth. I will hand over to you so you do another introduction just in case we have new members today, and then take us through the money investing skills. So karibu sana, Elizabeth.
Thank you, Daktari.
Can you hear us?
Yes, I can. Can you hear me?
Sorry, I think my mic is, all this time my speaker was off. Elizabeth, can you hear us?
Yes, I can hear you, Daktari.
I'm so sorry. I had switched off the speaker for my laptop, so I was wondering. Okay, let me allow you to be the host, excuse me, and you just take it off from here. So Elizabeth will be with us, we'll share for another like 20 minutes or 25 minutes. And then from there, we will now get into Q&A. So this is a webinar, it's being recorded. It's a webinar that's supported by Kingdom Bank, which is one of the leading banks in this country in terms of branches. And they're happy to take us through 4 series of webinars where we will learn together and earn together. So over to you, Elizabeth.
Great. Thank you, Daktari. My name is Elizabeth. I am an investment professional with over 18 years of experience, have been in the capital markets, leading some of the pensions, looking after some of the pension assets, and also in the unit trust business and specialized investment vehicles. So currently I am running the Hustler Fund as just a by the way. And I'm happy to be here to discuss about investments and investment options. And we have been doing this, I think, with Daktari for a while. So yeah, I shall do a quick presentation, really just to create a background in terms of what options we have. Then the conversations, I think, will be around largely what you would like, the questions that you have, and we shall try as much as possible to get the answers. Where we can't, then we shall follow up with that. So
are you able to think about your video? Just people to.
I'm off. Okay, sorry. Sorry, I was just getting in from Naivasha. That's why I'm a little bit all over the place. Let me just do that. Oh, great. You can see me now.
Yes, thank you. Thank you so much.
So when you think about investments, a lot of things maybe come to mind. What exactly do I want to invest in? What is really this investment all about? And everything in between. So when you think about investment options, I will concentrate largely on the formal investments. But let me take a step back. There are 2 ways you can invest formally. Formally is through organized institutions through the capital markets. So those are the things that I'm going to look at. What are capital markets? What options are there? But even before you get to investing the formal way, you have other informal ways of investing. Maybe something as simple as us giving money to one of us through a merry-go-round, and ways to invest. So well, you don't have to think about investment in terms of the content, in terms of shop that you have, or maybe even just going and starting a business, whichever kind of business, commercializing your hobbies. All those can be ways of investing and an income. So after you have made money, then you ask yourself, how can I then go all the way to creating more money using the where my time is not required? So when you think about it, you want to get to a position whereby you are actually, your money is making money for you. That is all where we want to be. We want to live a good life and we want freedom. And as we are looking for freedom, the only way to get freedom is actually being able to earn a living without necessarily putting your time in. So financial freedom comes with actually being able to free your time to do what you like with who you like at whatever time without necessarily think about money. So that is why investments comes in. So when you think about the formal ways of investing, and that is where I'm going to start the conversation today, there are different ways in which you can invest. And we shall go through that. But the key determinants of where to invest, there are actually three key determinants of where to invest. One is the risk level of the investment that you're undertaking, the return that you're going to get, and also liquidity comes in. When you think about liquidity, it's really how fast can I be able to convert my assets into liquid cash. So we could be thinking about, yes, I have a very good return. The risk is moderate, but I cannot be able to get that money. So when such situations arises, then that might not be the best investment for you, the goal specific that you have, which is maybe I need this money as an emergency kitty. So you really need to understand this investment that I'm putting in my money. How easy is it for me to get the money back? What is the kind of return? And what is the probability of me losing my money? If you remember what we did last week, we actually looked at the different levels and risk levels of investing. So if, for example, I'm investing for a short-term I'm putting my money for my kids' education, there is no way I can put that money in the stock market. Neither can I put that money in property, because in 6 months' time, I might not be able to get back the money that I have and the return that is projected. So it is very important that we understand those three things and ask ourselves, what exactly am I investing in? So in terms of the things that we are going to look at is the deposits, and also given the fact that this webinar is actually being sponsored by Kingdom Bank, which is actually one of the best deposit offering institutions. We shall discuss about that. Then government securities. Government securities, again, is a whole webinar that we had done with Dr. before. I shall just really go through it in passing. Maybe it's something that we need to do at a different time. Equities, investment, unit trust. I have not put real estate here because I know that is a whole conversation and it will take time. So in passing, we could discuss about it, but I just looked at really the formal ways of investing. So when you think about fixed deposits, the banks, we all believe that, or we all know that most of the time, the banks provide one of the most risk-free, almost like close to very low risk-free assets or investments. And you can actually decide different ways in terms of where your money is going to be. You can decide your money is in the current account, earning zero, or you can actually go a step ahead and tell yourself and say, I can put this money on a call deposit. A call deposit is that I'm putting this money, you'll give me a return, but the moment I need this money, please give it back to me. So if you want, maybe you're in the middle of a transaction, you don't know when the other person is ready to close, you can put your money in a call deposit. But if, for example, you know that for sure, these 3 months, I don't need this money, then you can actually negotiate and put that money in a fixed deposit. The difference is when you're in a current account, you're earning zero. If you move your money to a call account, you will be earning something slightly small. But if you have a definite time, you have 3 months, 6 months, you can actually be able to negotiate a much better deposit rate. But again, remember the amounts that you're holding also determines the rate that you're going to get. So even now, a step further, what the banks have done, they're actually now creating other products on top of that. So for example, you will speak to some banks and they will be able to give you a return that is pegged to a certain security. So for example, a government security. So if a bond is offering 12%, they would maybe give you 10% because they're pegging it on a higher or on a different investment. So that is what we call a high yield savings that is pegged on something else. But then definitely some of the banks will also have some nice savings options for you, whereby they'll take the money and buy on at the back of it some investment options that are geared towards retirement. So depending on what you're doing, remember again last week we said you have to decide what am I investing this money for and for how long. Once you decide that, then you can actually negotiate the right deposit with the bank, and also be able to actually match your liability with your income that is coming in. So for fixed deposits, one thing that I need to point out is if you have placed your money for 6 months and then month number 4, you come and you need your money back. In most situations, you lose the interest that you have earned. So you really need to be careful when you're also placing the deposit, because you need to know that you are truly matching what you need. Then the other one is now government securities. Government securities are divided into 2. You have the treasury bills, which are short-term, and short-term treasury bills are 1 day, 182 day, and 364 day. Here, you put your money and you are sure you have to wait until when maturity happens. On maturity, you get back your money. So the way the treasury bills work, it's on a discounted basis. So if, for example, I'm investing in a 1-year bond that is yielding 15%, I will not pay 100 shillings for the investment, but for every 100 shillings, I will pay 85. But on maturity, I'm going to get my 100 shillings. So that is called discounting. So when you're getting into a treasury bill, again, it is good to understand that you're going to be in that investment until maturity. So selecting the right tenor is very, very important. There are ways in which you can actually discount if in between you need to get back your money, then you can do what is treasury discounting, but it's very punitive. So if, for example, you bought a treasury bill at 10%, right now it's at 15%. If you want your money back in between, and they will discount it to you at the 15%. So you end up losing even the principal that you had invested. So you need to be very careful when you're investing with treasury bill. It is risk-free. However, you have to wait until maturity. Then we have treasury bonds. And in treasury bonds, there are of 2 types. You have the infrastructure bond, and you also have the fixed tenor bonds. The fixed tenor bonds, the government does not necessarily tell you this is where I'm putting the money, but for the infrastructure bond, it's very clear where the money is going to. Infrastructure bonds are better because they are tax-free. You enjoy tax-free. So if, for example, you're getting a return at 15%, it will be 15% that you're going to get. And the way treasury bonds returns come in is in form of coupons. So if, for example, I buy a 10% bond, every 6 months, I will get some income coming in, and it's called a coupon. But remember, the coupon and the yield that I'm getting, or the return that I'm getting, could be different. So it is always good to understand what is the expectations, and then you bid according to that. So for treasury bonds, the minimum investment amount for a fixed for the fixed coupon bond is about 50,000. For an infrastructure bond, it's 100,000. So there was just one of the most recent issued bond, which was a 5-year, which was yielding close to 17%. So you need to understand the market dynamics so that you can be able to invest. So in as much as treasury bonds are risk-free as well, when you buy a 15-year bond and you're not able to wait until the 15 years, you can actually trade it in the secondary market. The only risk is if interest rates have gone higher, then you might actually get much lower than the coupon, than the amount of money that you put in. So you need to be careful again on that duration matching, or with your expenses of what you really want to do. So in treasury bonds issued by the government of, let's say the government of Kenya, you can either do a local currency, those are largely what I have talked about, but they also issue foreign current bonds. And for foreign current bonds, you can actually buy even from other countries. So you need to understand what is it I'm trying to get. They are dollar denominated or they are euro denominated hard currency. So if you want to get a hard currency investment or exposure, then there are those options that are there. The only thing, again, the minimums would be slightly higher, maybe would be slightly higher than what you'd get in the local market. So government security is one of the best things to invest in. However, it comes with its own challenges. Just hold on up. Sorry. So the other investments that that I wanted to talk about is equities. So for equities, really investing in the stock market. So companies are financed in 2 main ways. You're either financing through equities or you're financing through debt. When it comes to equities, some companies have public investment or public investors in it. So whereby it is not only the people who started the organization that are the equity owners, or are the equity owners. So you end up having them as a public companies. Any company that has more than 50 people as shareholders is considered a public company. But not all public companies are actually traded in a stock exchange. So companies, in terms of the evolution, you start with very few people, so it's a private company. Then you bring in new shareholders, it becomes a public company, and then it becomes a public listed company. So as we speak, right now in the market, we have about over 60 listed companies. With over 60 listed companies, then the question is, how do I want to invest in? So with these over 60 companies, which are the right companies do I want to invest in? Then you need to make sure that you understand how to select the companies that you want to invest in. And the best way is actually to be fundamentally driven. Rely on research. Ask yourself, how will this company, what is the performance of this company based on the current macroeconomic environment? What is the management like? Are they doing the right things, or how are they increasing the chances of success? So investing in equities market is a little bit more work, and you need to make sure that you are staying informed. You actually take a very long-term perspective. So someone who had invested in Safaricom at the IPO bought it at 5 shillings. It went down to lower than 6 shillings. Then it went as high as 40 shillings last year, or almost 40 shillings, over 40 shillings last year. Now it has come down. So you need to make sure that you understand why am I investing in this company? And actually, one of the best ways is assuming the market was shut, or am I going to still invest in this company? Such that I'm not able to trade, will I still be holding this company? So you have to do the research and hold on to that particular, you buy the company that you think that you would like to have to the long term. So in terms of the stock market, you make money in 2 ways. One, capital appreciation. I'm buying Safaricom at 5 shillings. I think it is going to get to 10 shillings. So that is why I'm buying. So the capital appreciation. The other one is the dividend. I'm buying this stock at 5 shillings because I know that they're going to pay me a dividend every year. How do I tell that how they're going to buy, that they're going to pay a dividend? One, the conversation with the management, and also reading the news, and also just understanding what these people are up to. And then the other thing is, what have they done in the past? In most situations, companies try to be stable. So they don't want to bring a lot of shocks so that they can create stability. So it's good to do research and analysis. How can you do this research? You are busy. So the main way is really to read maybe the research reports from your broker, because they have people who wake up every day to do that. So to invest in the stock market, you need to open a CDS account. The CDC account you open directly using a broker. And even now, there's a lot of automation that is going into that end. So it's something that you can try and do. So the other thing is unit trusts. Unit trusts, again, come in different ways. So you remember I said there's the formal ways of investing and there is informal way. When you go to the formal ways, there are also 2 ways. Direct investing, that is what I have described when you're going to the stock market. There is also the informal way of investing, in direct ways. In direct ways, you're going through pooled funds. So these pooled funds are what are called unit trusts. So there are different unit trust providers in the market, and they actually declare their returns on a daily basis in the newspaper. So if you're going to read the Business Daily, you're going to read the Daily Nation, or you're even going to read the Standard, you'll actually see what some of these funds are doing. So when you're looking at the unit trust, the key thing is to ask yourself, what is the risk that I want? If I don't want to take any risk, then I go to a money market fund, a money market unit trust. Then I ask myself, which brand do I want to go with? Because in terms of regulations, it provides that the risk profile is not it's almost created in a very similar manner. So do I want to, which brand do I, the unit trusts are offered by fund managers who are either affiliated to a bank, affiliated to an insurance company or something like that, but they're also independent fund managers that are out there. So understand the brand that you want so that you can decide which particular investment in terms of money market fund you want to go with. If you want to take a little bit more risk, but you are sure that I do not want to do the analysis, so you can actually say, I want to invest in the stock market, but I do not have my time to understand what is happening in the banking sector, what is happening in the manufacturing sector. So you can actually buy into an equity fund. Or you say that, you know what, I think the economy is doing well or whatever, and I want to take a balanced investment. So I want to take a little bit of risk, but at the same time, I know I don't want a lot of volatility. So then you can go to what is called that balanced fund. So there is a lot of even specialized unit trusts that are coming up, one directed into direct investments into real estate. So you can actually choose what to invest in. So, but the starting point is understand what is there in the market for you to be able to take a view. So understand the investment objectives. That is what is called a fact sheet. So before you invest, get maybe the fact sheet from the fund manager that you're investing in, then understand what are the general expenses. Because you see also, you'll be told that maybe you're getting a 10% return, but is it net of fees or gross of fees or even tax? So always those are some of the questions that you need to ask yourself. So when it comes to investing, again, it's a process. You have to start with your goals. What do I want to invest in? What risk am I willing to undertake? Once I understand what risk I'm going to undertake, that determines the asset allocation that I want to take. Remember, asset allocation is really the proportion of how much deposits do I need, how much money market do I need, how much real estate do I need. Once I have decided what asset allocation I want, then I go to the second position and ask myself, who do I want to deal with? So that is called investments. I'm doing the investment selection. I want to be in money market, with who particularly, or I want to be in real estate. Where do I want to be in this real estate? And then now you can go through the process of actual execution in portfolio construction. And again, remember, we said things are not static. Remember that when things change, then you have to always change. Your portfolio is a live portfolio. So you have to always make sure that you are changing with the changing macroeconomic environment. You are changing with your own issues. If your personal issues or status change, you also need to do some reallocation. If, for example, you are employed and you lost your job, then remember what you would be more aggressive if you had a constant flow of income. But now, if that has changed, then there is that has to change as well. So you need to understand what are the key things that are going to trigger my asset allocation change, because this needs to be a continuous process. So I've talked about investments, but now what are some of the key ground rules of investing? One of the things is really start early. As you start early, not only do you have time for your investment to compound, you also have time to learn. Remember, you'll not get it right all the time, so you have time to fail and also correct your position. So start early. Then do not invest in that you do not understand, as a rule of thumb. I think that is one of the things that Liz, you said last week. Don't invest in that you do not understand. It is true. If you don't understand this, it is very risky. Just make sure that you do what you really, really can understand. You may not control it, but you are aware. Then do not follow the crowd, but do the work. That's why I talked about research. Some of us have invested in the stock market in the past just because someone else told us that they were investing. So I invested in maybe in Safaricom because someone had invested in Kenya and made so much money. So you want to follow the crowd. Just make sure that you do the work. Ask questions. In investment, there's no question that is silly. Remember, not only invest, I think in life, you have to ask, if you have that question in your mind, it means that it's a genuine question. So ask the questions for you to be able to understand better and to know how to proceed. Then if the deal is too good, look for the catch, because no one is going to tell you that, you know what, I am doubling my money, and yet why are they not investing even more? So always ask yourself, what is the catch when the deal is too good? And that will trigger you to ask why, and you know exactly what is the catch. So it is good to make sure that when you're looking at investment, understand where you are today, where you want to go, and what can get you there. Back to you, Dr.
Thank you so much. I think allow me to use my video also. In terms of, I think you have to speak a bit about, before you go to the questions, you have to speak a bit about real estate. Okay. And then if you're able to touch on insurance as a form of investment.
Okay. I'm trying to, how do I make you?
Let me take back control, no problem. You okay. Go on.
Okay. So real estate investments. So there are two types of real estate investment. You're investing to generate an income. So the way you do that is you invest, you construct, and then you start getting money in, or you buy a completed building. That is for income. Most of the real estate that we have maybe partaken or we have invested in is in plots. Let me take an example. When you think about plots investment, in as much as it is a good thing and people have made a lot of money, it is a speculative investment. So even as you purchase the plots, it is good to understand what are the fundamental drivers of return in this area. Is there infrastructure that is coming in? Are there facilities that are going to make this very attractive? Or am I going to invest in this particular real estate, hoping that one day government will change and they're going to bring infrastructure? So you have to really be sure what is coming around that area. So I'll give an example. If you have invested maybe in areas around the, is it the Eastern Bypass? There was the infrastructure really helped make the land appreciate. When you look at that investment compared to someone who invested at the same time, maybe in a place where now Kondani Kabisa, where we have not seen infrastructure coming in, you have almost stagnated. And let me give my life example. So I invested with Muhasibu because Muhasibu is who Muhasibu is. So there were some wiki plots that we invested less than 10 years, more than 10 years ago. Even today, the title, first of all, are coming out. I know the money will not get lost, but I can't sell it. I have been trying to sell it over the last couple of years. So you need to be very sure you're not following the crowd and you understand what are the fundamentals that are going to lead this. So it's good to understand what is the value driver. If you cannot point out the value driver, wachana nayo, it is going to just put you into trouble. The other question is about insurance. Insurance, investment, and Dr. I know you'll differ with me on this, but let me just say it the way I see it. Insurance, it's not investments. You are protecting risk. I'm buying education policy so that if I'm disabled, my daughters are going to go through school. So I do not expect that to give me a return. I'm going to get a 3-4% return, but I am happy because in the event that I don't make it, I know that I have secured the future of the people that matter to me. So insurance is not investment. It is actually a risk protection measure, which is also very necessary when you think about it. Yeah.
Thank you. Yes, I totally agree with you about the risk protection. And nowadays, I think there's someone in the panel in the audience that would want to speak more, maybe a little bit more about it. But for now, I think let's delve into the questions. If I may just give my own experience in investing, I've been before, I find it hard to understand some of these terminologies. So to be honest, I'm part of that audience or rather crowd that follows a crowd, for lack of a better word. So I remember when the shares were being sold, Everready, KenGen, I think Uchumi at some point before it went down, we really rushed to put in our money without understanding where the money was going. Everready went down with our money. Safaricom, I think also the amount of money we're putting in was so little that I still get dividends from Safaricom, but it is like 200 shillings. Yeah. So the paper that is printed on is more expensive than the value of the check itself. Then in terms of real estate, again, I've had my fingers burnt. I've put in money in something. It's not really burnt. It's almost similar like yours, in this property that also went into wrangles, and like 8 or 10 years later, it's now when some of us have gotten into the board of that company to just bring a bit of sanity and say, look, we are cutting our losses, but we need to move on because people need to develop these properties. But I've also had success stories. I think I usually share the off-plan investments that I do with one of the development companies in terms of small apartments. Then in terms of bonds, again, I didn't understand about bonds, but went in with a group that decided let's be putting our money together as a chairman, not together, rather collect, give it to one person, and this person has to buy bonds. So the learning about bonds has come much later. And that's just coming from the fact that, yeah, now my money is really going into it and I need to understand. The other one that you mentioned was equity shares. So for equity shares, there's also an organization that in the course of my professional work, someone came and said, look, I have this this company that I'm putting up, it's in the digital space in health. And it just so happened I had some money that was had received, and I put it in. Again, not understanding the digital health space. And at some point, I could see that startup was struggling, but I've held on. I've decided, let me just stick around and see where this thing will go. And it was interesting to see that in a recent government pitch to some of the foreign investors, that company was actually listed as one of the companies that the foreign investors could put their money in. So long story short is, I think I've been around. I have made money. I have lost considerable amount of money. I think we will come to one of the webinars where we are talking about extra money making skills. And that is usually also in the space of, people said, you're investing in my business, and you really, you can really lose it. So they higher the risk, they higher the return, they higher the risk. And I think, I don't know whether, Liz, you'll talk about personalities, because some of us are very high risk takers. We can decide today we are putting money in something that we don't. What I know is that I never put money in cryptocurrency, but in many of these others where it's, it's just about the wrong person rather than the concept itself. So investing in real estate, investing in shares, investing in bonds and whatnot, all these are tried and tested investment channels. And so the new ones are this cryptocurrency. So I don't know if you have a rejoinder, but we'll be talking, we have already some questions, so maybe we can jump right in so that we give people adequate time. As I mentioned before, this is the second series of our 4 weeks webinar series in partnership with Kingdom Bank. So the first one was in saving, how to save, and Liz took us through that. The second one is how to invest. Next week, Thursday at this time, we'll talk about how to manage your debt. I think it's not get rid of debt, but managing your debt. And the last but not least will be on how to make more money. So Diana is asking Liz that can she use bonds statement? So if she's bought bonds, government bonds, can she use it as a financial evidence of your net worth, so to speak? So for example, if they need to go abroad, can that be used in place of a bank statement? Thank you.
I think for sure you should be able to. I've not seen, I don't see the reason why not. And the reason why I say that is, if, for example, you wanted to start some businesses, like maybe like an insurance agency, that is even considered better than a bank, can come back. But I don't see why not, because it's actually a stronger investment than even the bank itself.
Okay, thank you. There's an anonymous question asking, can they buy shares for a minor? Will they have an individual account?
You can only open a trust account. I don't think you can open directly. And even for all the investments, they provide you can open in their name, but they have to have someone behind them. So it is good to open, but always know that you act like the trustee of the minor, because one of the KYC document is really your ID in most of the investments.
Yeah, I opened accounts for my children, and the other day I was so tempted to, because you have access to them, I was so tempted to withdraw money because I was in a tight spot. So yes, you need to be a custodian. Then we have someone who's asking, Andrew's asking, do we have any information on how we as local people can invest in green bonds?
Now, locally, we have one green bond that was issued by Econ and it's listed. So yes, you can invest locally in some green bonds. And if, for example, you're also looking at direct, bigger exposure in the green bonds, then you could look for investment managers who actually run green bond specific unit trusts. Because the problem with investing in the larger global markets directly, you have to have a lot of time for you to be able to do the actual trading. So my recommendation is usually you select the fund manager that you care for and then invest with them directly. And there are, I think you could think about people like Dry Associates. They would be able to guide you towards the right investment.
Then we have someone who was here last week, so thank you for coming again. The person asked that they asked about buying a block of flats versus building. Is there advantage over another? And how do you decide on a fair selling price? Is there a general rule? Thank you.
So if I remember this question, one of the things is building versus constructing. The key thing is the amount of time you have and the know-how that you do you understand the building industry very well. If you don't understand the building industry, you lose a lot of money. So in terms of deciding what to invest in, then there's a general rule. Maybe you need to get your money back in 10 years. So it's called a return on investment. So what you'll do is you calculate the rental income that you're going to get in a year, then you divide by 0.1, and that should be the maximum price that you're going to buy. However, the actual market today, if you talk about residential market, the best yield that you're going to get is maybe 8%, meaning that you'll break even 12 to 15 years. So then that is what you divide by the 0.08, and then you get this is a maximum value that I need to invest in this particular investment. So, but that is assuming the capital, the flats will not appreciate. So the reason why then you can take a lower return that is 8% is because also there'll be capital appreciation. You assume that in 20 years, I'll be able to sell this property at a higher price. But the general rule of thumb is rental income divided by the yield. The yield is anything between 8 and 10%. That is the maximum value. That's the maximum price you should be willing to pay.
Then Nancy is asking, would you recommend the strategies that we can use to manage investments during periods of market volatility? What strategies would you recommend? I think like right now we're in a period of a lot of volatility.
So there are two ways. You can actually decide to be an active investor, or you can actually decide to be a passive investor. The research has shown that active investment does not necessarily significantly outperform passive investments. And that is why, if you remember what I said about shares, you have to buy a stock that you are willing to wait on 10 years from today. So my view is if you're already invested, I think you hold on. If you have not invested, it is good to remain, take a little bit a wait and see. So invest in less, in near liquid investments, so that when you see that the tide is changing, then you can jump in. You'll never time the market. You see the market has cycles. You never time the bottom or the top. But as long as you can see the trend, then you can be able to invest. So active management might not be it, but I would say a long-term view. If you invested long-term view, if you've not invested, take a wait and see. A good example is this, the bond that is the current bond market. Yes, I think 13% looked like a deal. Now 15% looks like a better deal. 18% maybe look like a better deal. But remember, when you're still on the sideline, you will never understand it. So that's why I think, Dr. what you said about invest in it, learn in the process. So as long as you're able to manage it and don't dump all your investment at one go, that would be my recommendation.
And also consulting the experts, isn't it? We have someone who's anonymous who's asking on if you can repeat on how you can lose, quote unquote, on bonds when interest rates rise. I think you just need to repeat that.
So the value of any investment is the present value of all the future cash flows. So the present value of future cash flows, if you remember that math the math formula, 1 divided by 1 plus interest. You remember that formula? So if your interest goes high, it means that the value of the value of your investment has gone down because you're dividing by a higher denominator. So if interest rates go high, your cash flow is the same for bonds, isn't it? If I bought a 10-year bond, a 10% coupon bond, I will still get 5 shillings per 100 for the next 10 years. But if the interest rates now have come down such that my 10-year bond, I can only get it at 15%. my present value has actually not been divided. It's not been divided by 1.05, it will be 1.075. So then the value in paper terms has actually come down.
Yes, sijaelewa Liz, hata mimi, but
So I wish I know. You see, the present.
how to explain without the formula? Like,
yes.
Yeah.
Now you see, the valuation of anything, it's what is the. So the reason why we invest is because we want to grow the investments, right? Since we want to grow the investment, the way we grow the investment is by the interest rate that we are going to earn. So that is going forward. Now I want to bring that back. The value of what I'm willing to pay today for the cash flow that I'm going to get is the value of the bond that I have today, isn't it? So if my cash flow have remained the same, I am paying more today because I'm forgoing more today. I'm forgoing more consumption today for me to wait on. So in that case, I would rather consume my money today as opposed to waiting on. So that is basically the concept of the present value. I'm worse off today because consuming today is better for me than actually waiting on. So that is why when interest rates go high and my cash flow has remained low, it means that I'm worse off. But I will do a write-up and just to circulate together with the webinar so that someone can see it graphically.
Okay, I think that's
It's really a present value issue.
Yeah. So thank you so much. I think Nema is asking whether you can clarify on green bonds.
So lately, there is a lot of conversation about climate change and all those things. So one of the things, the ESG investing, whereby you want to be socially responsible. So there are investments that are more the characteristics. Okay, the investment so there is money that is being invested in some things. So the particular investments are actually more socially friendly, climate change friendly. So those are what are called green bonds. So they basically are investing in things that are going to help with climate change. So for example, if I'm going to invest in a building, the more I use solar, the more I use natural lighting, the more that can be considered as a green investment. So, and the green investment could either be a bond, equity, or anything like that. So those are the things that comes in the world is coming to a point whereby we need to protect the environment. So anyone that is able to raise money to invest in a way that is economically friendly, then that is what would be called a green bond. And that is why I think Econ was able to do a green bond, because if you look at what they are doing with their quote to housing, there is a lot of green technology that is being used in it.
Okay, Jackie would like to know, could you talk about setting up a trust and investing for children under the trust? And what are the benefits?
So investing in a trust, I will take two things. You see, once you invest today as an individual, so I'm investing as Elizabeth, the moment I want to transfer this investment to my kids, a lot of things come in. Your stamp duty, your REVA tax, there is a lot of things that come in which erode value. So you can actually decide, you know what, instead of investing directly as Elizabeth, I will invest in a company and then create trustees around them and say, this particular property will revert to my daughter when she turns 24, whether I'm alive or dead. And the income that comes from this, it will be specifically used for ABCD. So the reason why people do trust are two things. First of all, to protect the interests of the people that you're investing for. And also, it is an easier way of transferring investments without a lot of taxation, without a lot of surveillance, because once you do that company, what you do is just introduce these other members as shareholders or at the right age, and then they own the property. So it is one of the best ways of succession planning to avoid wrangles when you're dead. So remember, today you're creating a lot of wealth, but what happens when you are not there to give it to the people that were supposed to? So trusts are important, and that is the main reason that you need to do it. So how do you create trust? It is always good to do it through with legal help, because they will see the loopholes. That's one. The other thing is you could actually do it in a different jurisdiction. So it gives you those options of taking tax advantages in other jurisdictions, and then you can actually be able to grow your wealth even much better. So protecting yourself and also making sure that you protect the people that you care for and also reduce the tax issues.
Lydia wants to know if getting a mortgage counts as an investment.
Yes. The reason why taking and I think it's mortgage and debt. You remember that next week we shall be discussing about debt management, and mortgage falls under debt management. So as long as you take money to do an investment that matters, or a return, an investment that is generating a higher return, and return can be monetary, and it can also be, how do I say, feel good, or it feels nice to be in my own house or something like that. So there are things that are investment that you cannot put a return to, but they really matter a lot. So taking a mortgage, yes, it's an investment. The only thing that you need to be aware of is you've done the right DD and you're paying the right price. And then ask yourself, what happens in case in a situation where interest rates go up? Will I still be able to manage this loan? So you need to look at the mortgage in totality, not only as a mortgage, but in terms of the entire wealth creation. I think if you, again, Robert Kiyosaki is one of those people that says that you use real estate. The reason why real estate is important is because you can use other people's money to actually grow your wealth much faster. And mortgage is one of those.
So there's a question about the bond that had an interest coupon of around 16%. And there's usually that fear that with the current economic situation, that government may rescind on its premium. Is that a possibility? On the
in the world of investments, I think anything is possible. We saw Ghana restructure their bond, but the beauty about it is the restructure, it affects your cash flow, but it's not a complete default. Because by the time a country is completely defaulting, even us here, we are not really making any money. So I think the economic situation is wanting, in my view, and a lot needs to be done. Is it sustainable to continue borrowing at 16%? I don't think so. It is, because I'm just now trying to think about it, what this means for us. Yes, if I'm an investor, 16% is a no-brainer. It makes a lot of sense. But now, remember, I'm also leveraged on the other side. What means that if you have a loan, I'm sure you might have gotten a letter from the bank telling you, by the way, I'm revising 200 basis points or 2% higher. So the fact that the government is borrowing at those high rates, it, one, crowds out the private sector. We are not able to get loans. And then number two, for the people with loans, it actually makes it very difficult. And the way out of this is really maybe just I don't think a restructure is yet. We are not yet at the restructure level, but I feel like a lot needs to be done for the economy to be able to support that kind of return.
Okay. I ask randomly, how much is required to start a fixed deposit account and how much is the interest rate?
It varies from bank to bank, and I don't know if Dr. you have anyone from Kingdom.
I will chat on the side.
Yes, chatter. So it starts, I think it varies from different institutions, but even as low as I think as 100,000, you can be able to invest in a fixed deposit. The challenge is with fixed deposit, with 100,000, you might not be able to negotiate a higher rate like what you would get maybe in a treasury bill. Because you know the treasury bill, then it's average for everyone. So you need to understand, what is my bargaining power? So if your bargaining power is not as high, then you'd rather go to where the market, you get a market determined rate.
Yeah. Then I have a question from someone who's asking, between investing in fast foods over buying shares in a hotel. So they want to compare a fast food restaurant over buying shares in a hotel. I don't know how, it's super specific.
So this one is Dr. who will answer, because she's in the hotel business. However, one, how much time do you have? In a if you did a pizza in, do you understand pizza in business? So by the time you're putting your money there, please understand how money is made there. It could look good from outside, but unless you are there to know ni pakiti ngapi ya tomato sauce goes with each of these things, it might be something as simple as those little things that will make you lose money. if you're going to invest in a hotel, do your research and ask yourself, one, what is your counterparty? Who are you? Who is this person that is going to run that hotel? Do you understand? Do you trust them? And do you have the time to even understand? So your knowledge really starts there. Understand how people make money and how you can lose money, because in as much as you can make, you can also lose. So I will not say this is bad or this is not. I would just say, what is your knowledge? What time do you have? And how much money is required for each? Then make the right decision.
Yeah, I think there are quite a number of factors. One has accommodation, and accommodation brings a totally different ballgame to the tourism space. So also consider that. Then we have a question. There's quite a number of questions around shares. So I see how I will. Okay, in money market fund. So this person has 100,000. What else should they consider apart from the interest rate?
If I'm investing in a money market fund, investing in a money market fund, what else could I consider other than the interest rate? Honestly, when I look at the money market funds, the regulatory framework is really standard. So then that brings you to a very few kind of variables. So the returns, other than the returns, I think it's also the brand that you want to be associated with. That is really what I would say. Which brand am I more aligned to? And then also there is also, do not spread also your investments too much, in my view, because also managing become a problem. So if I have had a good education policy with CIC, the return is really difference of basis point, I would rather continue with that. If you have had the same with Corp Trust, why not continue with the same? So for me, that's what I would look at.
We have a question again on insurance, education insurance. So is it worth investing in a 10-year insurance policy, considering the fact that premiums are paid every month? And between investing in SACCO and insurance, which is more profitable?
So insurance is insurance. It's a risk policy. You're not going to get a return because of investing in insurance. You're going to get barely 5% if you're lucky. So you're not in insurance, you're not investing for return. For a SACCO, it's an investment. And I think the average return for SACCOs has been anything around 10%. So they are very unrelated sort of investments. The beauty about the two is that they help you invest at source so that your money is deducted. So you don't have to think about it. So to create the discipline. So each of these investments have a part in your investment portfolio. So there is that bit that you must put because of insurance. Insurance is important. Then SACCO is good because you're able to get a good loan, but at the same time get a good return. So can I invest in a 10-year policy? The answer is yes, because a kid's education is important.
Okay. And I was surprised at how fast those years go. So I remember, and sometimes we find insurance agents, Nancy, no offense to you guys, they can really pester you. So I think in my effort to just ward them off, I signed up to one of those insurance things. And I was pleasantly surprised when at 14 years, actually, the lady reminded me my insurance was maturing in a year's time. And it was interesting. Those years fly. So as Lisa said, it's about spreading the kind of investment opportunities. So we are almost winding up and we still have quite a number of questions. I think this was quite important. So I will ask a question that has not been asked. Are you able to share examples of successful opportunities you have identified in the past? I think that's an interesting one.
I will just start with what Dr. has said. Investing in the bond markets, I think it's a clear success story. And the way you marry it, and I don't know if that is what Dr. do, you get a coupon, you put it in a money market fund, and then it gets to 100,000, you put it in the next FB. So those are some of the series that are good success stories. I think also you've shared the education policy. Yes, I think some of us having gotten that maturity, you really feel nice about it. And it comes when you really need money for some strange reason. So those are clear, nice opportunities. I think investing in Safaricom, and forgetting about it, and then you realize, hi, yeah, it is at 30 shillings you sell, you feel nice about it. Yeah, so those are some of the success stories. Again, real estate, I think there's some people, you buy an off plan, then you're done and you get some money. Or alternatively, I think there are plots that are also good, whereby you because other people are buying, someone is really pestering you, you're paying pole, and then you end up making 4 or 5 times your money. So those are, I think there are a couple of us who can talk about good investment options or opportunities that have gone there. But also, there are also some of us who have also followed the crowd and lost money, like investing in quail business, and you don't know where the quails go. Yeah, so it's I think investment is interesting because you gain some, you lose some, but at the end of the day, you live to see another day.
Okay, so we have a question from Lucy who said she's a complete novice to this. She's now starting to educate herself in this world of investing. Where should she start as her confidence grows?
So Lucy, you can start by joining our class where we shall take you step by step of how to invest. We do a prosperity course whereby it's 4 sessions whereby we take you through. First of all, let me understand who I am, what I want to do, all the way to investing. Once you're done with that, start with the most risk-free, lower risk investment. Let me not say risk-free, lower risk investments. Like when you go to unit trust, please start with the money market. Usianze na equity, it will shock you. Today you have 100,000, tomorrow it's 70, and then the next day it's 120. So I start with the money market fund, start with the treasury bills, bonds, because that way you're sure your confidence is growing and you can actually not be able to take more risk after that.
Thank you so much, Liz, because I'm very particular about time. I think we will wind up there. I have captured, because this is a recorded webinar, we have captured the questions that have not been answered, and so we will share responses on email as I'm sending up a follow-up, or also in the next session. I think we can start with those ones. Again, many of them have been answered within the presentation, so if you came a bit late, this webinar will be shared. So we have a question again from our audience. Liz, I think people really find that you have a lot to share, so how can they get in touch with you?
Great. You can get in touch with us on email at info@zurich.com. We actually have come up with a way to help you grow your wealth. We believe that in wealth creation, there are 2 things. First is understanding, and then number 2 is the accountability framework. Not partner, you can have a partner, but also the framework that works. So we will be your accountability framework. You can reach out to us. I will also share my number, where you can, once you chat me, I'll be able to get you to the right person to answer or to walk the journey with you.
Thank you so much. So regarding the fixed deposit, I think that was one of the questions that's been repeated again. We do have our partner Kingdom Bank, and if you go to their website, just type the Kingdom Bank Kenya, you'll get all information about their fixed deposit accounts. I had shared today about my journey in entrepreneurship, my second attempt at entrepreneurship. And when you're used to a salary, then it comes with certain perks that entrepreneurship doesn't give you. So one of the things that I was required to do, and I'd totally forgotten about, was renewing my medical cover, given, again, as Liz has mentioned before, insurance is very important. And you need to take insurance for yourself. In terms of medical insurance, you need to take insurance in terms of your life, in terms of your properties, in terms of your business. Nowadays, there's even a business insurance that protects all the hard work that you've put in. Because we know that with one admission in these hospitals of ours, you can wipe out all your savings and investments. So please remember to talk about insurance, to talk to someone. I tagged my insurance agent who has really supported me, and she's a broker, and so she gives you various options. Liz has put her number there, so feel free to reach out to her. She's doing this pro bono, so we really appreciate. And as you had her say, she is actually running one of the government agencies, and as such, we really, really do appreciate that she takes time to educate us. Go to our website also, it's zuriconsulting.com. But we'll also share all this. As we share the webinar, we'll put in the link for both the bank and the consultant's website and number. So thank you so much. It's bang on time. We really appreciate it. We see you next week. I think that would also be interesting because I've been in a situation where I needed to manage my debt, including selling a very precious asset in order to just basically be able to stay afloat. So it is not something to be ashamed of. It is something that we need to be aware of, and there's good debt and there's bad debt. So looking forward to seeing Liz next week as she takes us through debt management. Please feel free to share with your friends, and all these webinars are being uploaded on my YouTube channel. That is Amakove Wala. You'll find it on YouTube. Thank you so much, and thank you, Liz. We'll see you again next week.
Thank you. Bye.
Bye-bye.